Is there a real chance for a Fed pivot? Here to discuss, Greg Dacko is chief economist at EY Parthenon. Peter Boockvar is chief investment officer at Bleakley Advisors and a CNBC contributor. And CNBC's Steve Leisman joins us as well. Welcome to everybody. Steve, help us kind of sift through all of this. What's the noise? What's the signal here?
Well, it's hard to figure out what's going on when a big shoe company is coming to market, Kelly.
Or
they are a shoe company, right? I'm just having a little trouble getting excited about a shoe company, but I hope that's not the cutting edge of American innovation. In any event, what's happening here is the Fed doesn't quite want to pivot yet. It doesn't want to give up the ghost of potentially hiking again, but it doesn't feel like it's going to do it anytime soon. And I'll explain to you a couple things. Let's look at Waller. Waller in early September told me he thought the Fed could wait and see. And that was like, oh, okay, so you're not going to hike in September, but that November hike is still on, right? Now he's saying, maybe not. We still can wait and see, which kind of takes November off the table. And if you look at what happened today, the probabilities, we went down below 10% on the November hike. We're down, 25, 26% on the December hike. So the market has taken that hike away. The Fed has not quite taken it away rhetorically. The only one who has definitively is Bostic from Atlanta, who said the Fed is, quote, sufficiently restrictive. That's the full stop phraseology right there. And I will tell you, every reporter in the press room, everybody who looks at the minutes today is going to do a word search on the word sufficiently to see if it's in the minutes.
And we should explain that's why you're there with those nice flags behind you down in Washington, waiting for those Fed minutes to be released in about an hour. Greg, the minutes matter to you today. What do you think the market is doing here with this big pivot on the long end? Is it fundamental? Is it technical?
Well, I think what Steve mentioned is absolutely correct. We are in an environment where the Fed has struggled really hard to commit to its message of higher for longer. So now that it has achieved that, there is a desire to avoid markets pricing in rapid rate cuts over the course of the next year. I think what we're seeing in terms of economic data is that we are in a disinflationary environment. We are seeing ongoing signs that disinflation is proceeding, especially if you exclude some of the bumps in the road from higher energy prices. And that should allow the Fed to essentially maintain its policy rate in the restrictive range where it is right now. But there is going to be this optionality of still proceeding with further rate hikes if there is the need to do so. That will remain part of the Fed's communication going forward.
Peter, what would you add to that? And what do you think is going on with the kind of global financial landscape more broadly right now?
Well, we definitely pushed the overbought condition to an extreme in terms of yields, the dollar, and the price of oil when it jumped above $90. So all of them sort of relieved themselves together. Oil came in, the dollar sold off last week, and yields have dropped. I think it's very important that a lot of Fed members have also talked about financial conditions, because you can't ignore the long end of the yield curve when you're trying to figure out where to put the Fed funds rate, because mortgage rates are directly tied to the 10-year. And mortgage rates and the housing market is probably the most sensitive part of the economy to Fed policy. So we've had a 100 basis point increase in the 30-year mortgage rate since the July rate hike. So the Fed had no choice but to acknowledge that and incorporate that in their modeling and how to figure out what to do with the November meeting. And I think that's why I think a lot of them backed off from committing to another hike.
Yeah. Sorry for misspeaking. Yields are moving up as a result of what Rick was just describing there, the collie tail on that auction. Peter, what were you saying?
Yeah, I think Rick is right that the geopolitics complicates the messaging that they're trying to glean from the long end of the yield curve.
In what sense? Because it seems like the major move has been people going back into treasuries, flight to safety, flight to quality, whatever you want to call it. Do you think that that's not legitimate, that it just has to do with the conflict that's erupted?
No, I think it is partly, but again, since their July meeting, the long end of the yield curve up 100 basis points is something that, regardless of why, it's going to have a dampening impact on the economy.
Yeah, no, it's a great point, and that's why we've started to hear the Fed speak like you're talking about. Greg, what would you add to that, and what further commentary is significant to you from Fed officials, whether in the minutes we're about to hear or in their remarks? I mean, if they're done, then what?
Well, I think it's very important actually to understand the why we're seeing this tightening in financial conditions. Over the early part of this week, I moderated the conversation with Lori Logan, the president of the Dallas Fed. And she highlighted that it was important to understand why long-term yields had risen. Is it inflation expectations? No, it doesn't seem like it. Is it the sentiment that the economy is more resilient and more inflationary? That, again, doesn't seem to be the case. Is it a higher neutral rate? Potentially, but that's not a big factor. Then it comes down to the term premium. Is it the fact that we're running larger deficits, less demand for bonds or less reliable demand for bonds, and potentially more inflation volatility in this complex geopolitical framework? I think that's the case, and that would be more reason for the Fed to essentially hold steady where it is right now.